This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Welcome to Bloomberg Businessweek Daily. I'm Carol Massar, along with Tim Stenovec, live at Bloomberg headquarters in New York City. Yes, it is the first Monday in March, first trading day in the month of March, and it is quite a trading day. It's got to be kind of an interesting one. Of course, day three, as we just heard from Tim, of the U.S. attack on Iran. You've got strikes continuing, bonds slumping as oil has surged amid that escalating war in the Middle East. Concerns over inflation, though, heightened by a report showing manufacturing here in the U.S. expanding with input prices soaring. So you've got some of that at play. I will say, though, equities are definitely off their worst levels of the session here.
Yeah, in the S&P 500, it was down as much as 1.2% earlier in the trade. I think a lot of people thought today would be a real risk-off day. We saw the trade turn around in the early part of the morning. And we're going to have more from Charlie in just a minute, but suffice it to say that the S&P 500 down only 0.2%. The NASDAQ, though, in the green, up 0.1%. The Dow down 0.3%.
Got to say, I've been kind of surprised by the strength, and we saw it even in the early market trade here in the U.S. in terms of futures. Hey, coming up, we are going to focus big time on global markets, U.S. markets. Jamie Dimon, Chairman and CEO of JPMorgan Chase, he's going to be live on everything from AI to private markets to war. So we'll hear from him in just a moment.
Yeah, we got another great market voice, Michael Contopoulos, with us, Deputy Chief Investment Officer over at Richard Bernstein Advisors. He's going to join us in just a few minutes.
He definitely has some thoughts on that inflationary play. And Danny Moses, founder of Moses Ventures, you might remember him from The Big Short. He has some thoughts when it comes to private credit and more. So looking forward to him weighing in on all of this. All you need to know in terms of the market trade. We've got a bunch of great voices coming your way in just a moment.
All that and more coming up over the next hour. First up, though, check the day's trade and top business stories. Here he is, Charlie Pellet.
Hi, thank you very much, Tim. We've got stocks fluctuating with the S&P now back in the red, trading lower by just about 10 points, 68.69 where we stand on the S&P, down 0.1%. The Dow lower for the entire session, down now by just about 0.3%. But the Nasdaq Composite Index is hanging in there, holding on to a gain of 36 points now, up by about 0.2%. The VIX at 21. We've got the 10-year yielding 4.04%, with the 2-year 3.48%. Gold up $42 the ounce, 53.21 the ounce, up by about 0.8%. And West Texas Intermediate crude spiking up 6.1%, 71.08 a barrel, as the Middle East war all but halts oil traffic through the Strait of Hormuz. Brent, the global benchmark, up now by just about 6.6%, 77.65 a barrel. Oil majors all gaining today. ExxonMobil shares, they're up by 0.6%. Chevron up 0.8%. ConocoPhillips is rallying 2.4%. Again, recapping, S&P down 0.1%. The 10-year 4.04%. And West Texas Intermediate crude oil up 6%, holding just above 71 a barrel, 71.06. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So as you know, as we've been reporting here at Bloomberg, U.S. and Israeli joint strikes continuing across the Middle East. This is for a third day as Iran continued to fire missiles at countries around the Middle East in response to that attack, causing major disruptions and a surge in oil prices, with Qatar and the UAE lobbying allies to help persuade President Trump to reach for an off-ramp. And earlier this morning, Tim, we heard from a lot of important voices on all of this.
Yeah, U.S. Secretary of Defense Pete Hegseth was joined by Dan Kane, U.S. Chairman of the Joint Chiefs of Staff. They spoke at a briefing at the Pentagon. They took questions. Also, just a little before noon, Wall Street time today, President Trump, at a medal ceremony at the White House, he addressed the U.S. and Iran.
Today, the United States military continues to carry out large-scale combat operations in Iran to eliminate the grave threats posed to America by this terrible terrorist regime. We have the strongest and most powerful, by far, military in the world, and we will easily prevail.
The mission of Operation Epic Fury is laser-focused. Destroy Iranian offensive missiles, destroy Iranian missile production, destroy their navy and other security infrastructure, and they will never have nuclear weapons.
The combined impact of these strikes, swift, precise, and overwhelming, has resulted in the establishment of local air superiority.
Our ambitions are not utopian. They are realistic. This is not Iraq. This is not endless.
Whatever the time is, it's okay, whatever it takes.
Again, that was President Trump at the White House today around noon, Wall Street time. We also heard from U.S. Defense Secretary Pete Hegseth there, and also Dan Kane, U.S. Chairman of Joint Chiefs of Staff. That was at a morning briefing from the Pentagon. As we said, U.S. stocks seem to be taking a lot of this in stride following Asian and European declines earlier. We did see the U.S. dollar rally. We've seen Treasury yields here in the U.S. also moving up on inflation concerns, and of course, gas prices surging as well. There's been a lot in terms of markets. Curious to see what our next guest has to say, because it does feel like there's a lot continuing to come at investors. Michael Contopoulos is Deputy Chief Investment Officer at Richard Bernstein Advisors. They have about $17.5 billion in assets under management, that as of the end of September. Mike joining us right here in studio. Good to have you here.
Nice to be here.
It's been an interesting 2026 already, and it just feels like the invasion, the attacks on Iran kind of add another layer of risk to what's already been a pretty fragile market. So I am curious, before we get into portfolio management and what you should be doing, it feels like the first question that needs to be asked is what's really changed as a result of what happened over the weekend?
Yeah, I mean, I think it's too soon to tell exactly. I think you hit the word of the day, the nail on the head, which is uncertainty. Uncertainty has really been a staple, I think, for the last 18 months or so, is going to continue to be a staple. I think gold is reflecting that and has reflected that over the last year and a half. But I do think, listen, wars in general never really are disinflationary or deflationary. I think the bond market is picking up on that at the moment, whether that be because of the obvious oil and natural gas disruptions, or whether it be more due to supply chain issues. It's hard to make a case how what we saw over the weekend is going to lead to deflation or disinflationary forces. And
especially going into it, there were inflationary concerns.
Well, that's the thing, is that, I think even without what was going on with Iran, you've been seeing inflation start to tick up pretty meaningfully. Remember, core PCE is what the Fed cares about. And core PCE bottomed in April of last year. You look at ISM input prices today, you look at the PPI data, it's all suggestive of higher inflation, not lower inflation. And so this just adds another wrinkle to that, which I think the bond market is getting right? You started off with the flight to quality and lower yields, and that quickly reversed course, and now you're seeing higher yields, and I think that's the right reaction.
Can we extrapolate this to midterms and in an environment where voters care about the economy, voters care about prices, they care about inflation, and what this war could mean for a change of control in Washington? Not at the presidential level, of course, but maybe in the House, maybe even some are saying in the Senate.
Yeah, I think ultimately what matters for markets is less politics and more what the trajectory is for liquidity and earnings. And so to the extent that, how does it matter to markets? I'm not sure the midterm elections even matter all that much. I think earnings growth is reasonably strong in the U.S. It's certainly expanding globally pretty dramatically. What happens with the midterm elections is not going to affect what happens with European earnings and emerging markets, ex-China earnings. I actually don't think politics are going to have a huge influence on rates either, which I know is probably maybe a controversial statement in and of itself. But I think the markets are smarter than what's going on with politics, and investors will be investors. And the midterms are going to prove to be much less exciting for markets than maybe what most expect.
What could be exciting in a negative way is some kind of crisis. And I just do feel like the drumbeat is expanding. Former Goldman CEO Lloyd Blankfein speaking in an interview with Citadel's co-chief investment officer about how he can smell a fresh crisis brewing and sees similarities, parallels to the mortgage crisis. And then it was just Jamie Dimon that we heard from about a week ago, and we're going to hear from him in just a moment too, live on our air, warning of parallels to the financial crisis. What are the major risks? Which seems like a stupid question coming off a weekend where we have seen the U.S. and Israel attack Iran, and we see again unease, unrest, if you will, in the Middle East. What are the major risks? And is it, we've seen credit spreads widening a little, like we see things percolating, and yet that doesn't necessarily mean crisis.
Yeah, I do think that the stage could be set for credit weakness, We've been saying that, admittedly, for probably a little longer than what it's taken. Yeah. About 18 months ago, we started talking about the illiquidity risk with private credit, and we're starting to see that actually, happen over the last few weeks and over the last few months. I think, absent from Middle East tensions and sort of war, and I'll talk about that in just a moment, I think the credit space does pose a bit of a risk here. Not so much from mass defaults and that causing a recession and any sort of contagion similar to the global financial crisis, but more from the perspective of having these very illiquid products. And what do you sell when you can't sell what you want to sell? You sell what you can sell. And so that can sometimes beget a crisis in and of itself.
Who gets hurt in that process?
Well, I think certainly private credit holders, but also just credit markets in general. I think if that comes at a time where you have higher inflation because of geopolitical risk and higher rates, that can cause meaningfully wider spreads in credit risk as well.
Something that's not lost on us, and we talk about this all the time, is that this is happening at a time where certain people want retirement accounts open to private credit.
Yeah.
And the idea that, everybody should have an opportunity to invest in what many argue is an opaque asset class. How do you view that?
So it's interesting. Rich Bernstein, who you all know, and is, of course, the founder of RBA, wrote an interesting report several years ago about what sort of are the makeups of a bubble. And one of the key makeups of a bubble is democratization of markets. And I think that's what we're seeing here. That's essentially what you asked him, is sort of the idea of private asset classes within, retirement accounts and these sort of things, alts and all this, in illiquid asset classes within retirement accounts is democratization, just like, the gamification of trading has been. And so,
well, I mean, at the end of the day, the people who and correct me if I'm wrong, Carol, but it seems like the people who want this in retirement accounts are the ones who sell it.
Yeah.
And the ones who, would benefit from a larger market of people or entities buying these assets.
It feels like there's a lot of money to put to work, and they're searching for more markets to put it to work. And
it's a good way of saying
that makes me a little nervous.
Yeah, I think you mentioned Lloyd Blankfein earlier. He had a good quote about this and how many of his peers out there have made substantial sums of money doing what they're doing, and now they're trying to even grow that more. And what's the real need for that? Those are Lloyd's names, words, not my own. But I do think that is an interesting point. But listen, this is an industry. The asset management industry is one where you get paid to grow assets and perform, right? We focus on the performance side and let the asset growth take care of itself. But it's hard. It's easy to see how those can get, those objectives can get muddled.
Michael, just got about 30 seconds here. This moment in time, how do you suggest investors should be investing? Should they be making adjustments, thinking shorter term? What's your thoughts here?
Certainly not shorter term. I think investors need to think like investors and think over the long term. Currently, we want to be underweight really expensive excess in the markets, investments that are driven by liquidity. We think liquidity will tighten more. That means basically underweight long duration assets, speculative U.S. technology, China we would put in that boat, and overweight, shorter duration assets. Companies that pay dividends currently value short duration, high quality fixed income.
All right, going to leave it there. Come back soon.
Thank you.
Please. Michael Contopoulos, Deputy Chief Investment Officer at Richard Bernstein Advisors, joining us right here in studio. All right, folks, we've got another great voice to talk about the environment, the macro. We're talking about Jamie Dimon. He's, of course, the CEO of JPMorgan Chase, and he is there in Miami at the JPMorgan Global Leveraged Finance Conference with our own Lisa Abramowicz, one of the co-hosts of Bloomberg TV's Surveillance. Lisa, take it away.
Thank you so much, Carol. I am here with somebody who does not need an introduction, Jamie Dimon, who is the CEO and chairman of JPMorgan. It's a really interesting day to have this. First of all, huge turnout, but the focus, at least in the news world, is very much in the geopolitics. And I'm wondering, from your perspective, you talked about geopolitics for a long time. Are you surprised that the market has been so sanguine to any kind of response or any kind of geopolitical disruption?
Hi, Lisa. Hi, Bloomberg. Not really. So one of our brilliant folks wrote a report years ago, Mike Semblis, that if you look at all these wars around the world since World War II, the market reacts, but it never had a real long-term effect other than the Israeli conflict when the oil prices tripled and went on for an extended period of time in 1973. So the world kind of takes its stride, but geopolitics is a major issue. It's much more complex today than it has been since World War II. I'm talking about Ukraine, Russia, Iran, North Korea, our relations with China, and that could have an effect, but it may not. So these things may diminish over time. this war with Iran, if it is short and oil goes to 80 or 90 or 100, but it's a short time and not prolonged, it probably won't have a major effect. If it becomes prolonged, then all bets are off the table.
Well, how offsides would this market be if there were truly a stagflationary shock, given the fact that there seems to be comfort with the idea of disinflation right now?
Well, I think that's true, but I think that was true before this war. So if you look at, my view is the asset prices are kind of high, credit spreads are kind of low. There's kind of a lot of complacency in the market. I'm not sure, we look at risk, we look at the broad range of outcomes, and there are negative outcomes, but one of them would be, inflation. I call that's the skunk at the party. So it's been coming down, but it seems to maybe have leveled off around 3%. If things make it go up, and this is only one thing, you can look at medical prices, construction prices, insurance prices, wages for certain things, other things, inflation is a big thing, it's not just oil. So we'll see. Right now, this will add a little bit, literally a teeny bit to inflation, not a lot.
I was surprised because things were kind of gloomy coming into today, and the mood here is not that. Actually, there's a lot of optimism. There are a lot of different companies that are building things and investing things. I mean, how vulnerable really is the U.S. economy right now to some sort of geopolitical shock?
Well, it may not be geopolitical. It may be the companies will start to lay people off. And so I look, the most important thing in the world today is geopolitical. What happens to the free Western democratic world, which has kind of been under attack by Russia and Ukraine, by Iran in the Middle East, a little bit by China, who wants to, divide and conquer the Western world, and, both militarily and economically. You have all their neighbors are rearming because of their actions, not because of anyone else. So those are the most important things. I'd add global deficits are so large, but those are like, I call them like large moving tectonic plates that may or may not affect the economy in the short run. They may be determinative in the longer run. And some of these things, when you talk about war, Vietnam, did it affect the economy in the very short run? No. It had a 20-year effect after that. So you got to look at these things as they're moving plates that can take 5 years to have an effect, but the effects will be real. Right now, the economy is doing fine. Asset prices are high. People are assuming things go on. I mean, no one you talk to has any idea the credit spreads can gap out a lot. And they could, just because of sentiment. And so yeah, I think there's a little bit of, a little more exuberance than I think there should be. But we've had years of it. And, the one big beautiful bill adds to growth this year. Bank deregulation, other deregulation adds to growth, and animal spirits. So we'll see. But you pointed out, I think the skunk would be inflation. So we got to keep our eye on that one closely.
Yeah, well, and this actually speaks to something that people are wondering, which is what's going to potentially crash the party. Before we get into credit more significantly, I know that JPMorgan has been expanding significantly in the Middle East, particularly in Riyadh and Dubai. If you take a longer term view, does any of what we're seeing now have the potential to shape that effort to expand either in the positive direction or potentially to withdraw in the effort?
I think the way I look at it, it creates more risk. It creates more chance of a positive outcome. So all those nations have been modernizing, educating their people, adopting more and more Western methods, wanting to open up their markets, bring in foreign direct investment, invest overseas. That won't change. In fact, and Tom Friedman wrote about this in his paper today, that this creates a bigger opportunity for long and just peace in the Middle East. And writ large, not just Iran and this war, but that Saudi Arabia, UAE, some path to statehood for the Palestinians in Gaza and Palestinians, that's going to be up to them. There are reasons to be optimistic. This opens the door for that. And there are a lot of naysayers. I understand that. And if things go south, they can say, I told you so. But this does open up the door for that. So hopefully we're wise enough to help move in that direction. And if you watch closely what's going on in the Middle East, Saudi Arabia, UAE, Qatar, Kuwait, they all want peace. And they all know that really growing and having great economies rely on that. You want to get more foreign direct investment, you need peace. And things like war reduce the chance that people don't want to put real investment in the ground. So, and then they even set up a shadow government for the Palestinian Authority with Palestinians, but professionals, lawyers, doctors, business people, to create maybe a governing structure that can actually uncorruptly govern Palestinians and create peace on the ground there, and have Israel and Palestine work on a long-term course, but of course to peace side by side with statehood. So we'll see. I mean, look, on that one I want to be optimistic, even though it's been terrible now for a long time.
You were talking about credit, and I do want to return to it, and what could potentially cause the credit cycle to crack. Even if we don't know the catalyst, do you have a sense of what this credit cycle is going to look like? If it's going to be akin to something that we've seen in the past, or if it's going to have a new kind of dynamic?
Yeah, so some things rhyme and some things never change, okay? There will be a credit cycle. It's usually caused by a recession. The type of recession determines the nature of it. So stagflation is very different than just a recession, obviously the depth of the recession, and a credit cycle is a normal cycle. One of the things that's always different is which industries get really badly hurt. Like you may remember in 2000, it was telecom and utilities. You know, the Ma stocks, they pay dividends. In 2008, it was Warren Buffett stocks, media stocks. You know, this time maybe it's software, maybe it's not, but something's moving that changes the type of credit. I do think it'll be things that cause a recession. Could be geopolitics. It could just be, you know, people pulling back in their spending and companies are laying off, or they can't pass on prices or something like that. But I do think when we have that cycle, it will be worse than people expect. We're late in the cycle, we're a lot late new entrants. There's some people out there who aren't doing great credit because we see the other side of it. And I'm not talking about private credit, I'm talking about credit in general. That could be insurance companies, it could be private credit, it could be banks. We see some banks doing things that, you know, we probably wouldn't do. So there will be, and the other thing about credit, there's always, if you look at the outcomes, there's always the people who did it well, they still have a cycle, and the people did it really badly. So, you know, that's not going to surprise me when we find out who's swimming naked when the tide goes out.
So you don't think that private credit's the epicenter?
No, because private credit, I mean, give you big numbers. Corporate debt in general is in pretty good shape. Consumer debt in general is in pretty good shape. And you take private credit, leveraged lending, $1.7 trillion. Banks do $1.7 trillion. The high yield market is $1.7 trillion. I wouldn't put that in the systemic category, even if it gets worse than people expect. So.
Do you think, given the fact that JPMorgan is lending significantly as well, I'm just wondering how you sort of guard against a credit cycle that you think is going to be worse than people expect at the same time that there are opportunities and there's a growing economy? I mean, do you have to keep more cash? Do you have to be more conservative?
So we always run the risk management we do is we always run the company looking at a range of outcomes, and so that we can handle it easily so we can continue to serve our clients. Like there are 3,000 clients here, investor clients, 250 corporate clients. So whatever the environment is, we're going to be a good serving you properly. I don't have to worry about that. And we're going to invest in our future, whether it's technology or new branches in new countries. So we always run it that way, looking at our margins and things like that. Now, of course, we manage credit. You know, some of the credit's just managed because, you know, people want a loan, they come to us, we offer X, and someone does something more aggressive, and we lose. And we're totally fine with that. We've seen a bunch of that on the leverage side. Sometimes we tighten our standards. You know, we want more covenants, we want more collateral, we are doing less subprime. You know, we trim our sales and credit card, for example, or you have lessons learned. And once the lessons learned, you make a bunch of change underwriting. But we've always been pretty good at underwriting credit. So when there's a cycle, it's going to run through our books too. But we're adults. You know, reduce our results, we'll still be fine.
You talk about some of the technologies in order to serve clients. Artificial intelligence, a huge focus, and there's been some pushback by JPMorgan investors about the amount that JPMorgan is investing. How are you looking at what areas you think JPMorgan's going to win in as a result of AI? What gives you confidence?
So everything we do, whenever we meet, if you were running a business at JPMorgan at that level, credit card, auto, you know, mortgage, sales and trading, we always say, what are you doing to grow your business? And that could be adding great salespeople, if you're adding countries. Very often, it's adding technology. It's various forms of technology. It's just building something that's a digital account or an API that a customer wants. You know, AI, and more it's AI. So we use AI for risk, fraud, marketing, underwriting, note-taking, idea generation, error reporting, reducing errors, and it's, you know, and there are 600 use cases, 50 I'd put in the important category, and that's part of what you do. It's no different than the past. And if we can use it to do something better, faster, quicker, cheaper, higher stat from the customer, we are going to do it. And so AI is the new front of, you know, wonderful stuff coming. And I think for society, you got to remember, people talk about the negatives. You know, my guess is, and I really do mean it, like maybe in 30 or 40 years, your kids, you have 2 kids, right, are going to be working 4 days a week, maybe 3.5 days a week, living to 120. A lot of cancers will be cured, a lot of disease will be cured, food will be safer, cars will be safer. It will be a wonderful thing. The risk that people are focused on today is that somehow it gets deployed so fast that people don't have time to adjust to it. There are too many layoffs, and I think that's legitimate. So companies should be thinking about how they're going to handle that. And, you know, I've suggested, I may write about this, that, you know, the government should start thinking about how can we help get the benefits of AI and diminish the negatives. And that would basically be retraining, relocation, how you use your high schools, your colleges, your community colleges, to reskill, but even people who are 40 or 50. And it's all doable if we think about how we're going to prepare for it.
Well, do you think that there is going to be a smaller workforce for each sector? I mean, for the banking sector, for example, if you can consolidate a lot of market share and you can analyze things much more efficiently, maybe your overall workforce doesn't shrink, but your overall book of business expands dramatically. Yeah. I mean, how do you see that?
I think there will eventually be some shrinkage of the workforce. And I think if you're ahead, you have a temporary benefit. Remember, the competitive capitalist world, people will catch up. And even smaller banks, who we support ourselves, will get the same services directly from Claude or from, or from FIS or something like that. So it isn't like you're going to have a permanent advantage. You have temporary advantages, and if you stay ahead temporarily, you have an advantage. But I don't think you have a winner-take-all thing. The world is really competitive. And then look at it. Also opens up, in a good way, competition. So fintech. So we now have all the big bank regular competition. But we also have hundreds of fintech companies who are using new technologies to sometimes take just a little sleeve of business and then expand it, and and it could be data, it could be trust, it could be rent payments, it could be cross-border payments, it could be anything like that. So, and I appreciate that, but we have to. Some of that money is very specific. We need to do that too.
Jamie Dimon appreciates stablecoin, but no, thank you. I will take it back. I mean,
we have no problem with stablecoin either.
Okay, no. But there is definitely the cannibalization.
Properly regulated, yeah.
Yeah. Going forward, though, do you find a reluctance by some employees to adopt to artificial intelligence because they're worried about losing their jobs?
Not really. Yeah, we have this. So we use, like I said, with 600 use cases. We do it everywhere. But we have on our phone an LLM suite, and we have like 12 or 13 or 14 products that you can use to review your own documents, to summarize research, to if you want to ask the lawyers want to ask how many legal documents of 50,000 documents have these things in it, and it could review that and tell you that in minutes. And 180 or 160,000 people use it a week. So it's adopted. They say they're saving 4 hours a week on it. Now we don't include that in how we look at productivity because we don't really see the productivity. They're using it for research, note taking. They're going to go see a client. What might the client be interested in? Those use cases those 12 products are being every week. They're adding like new products to do different types of things for our own employees.
So the mood music so far this year has been kind of negative around the economy and sort of the worries about credit in particular over the past couple of weeks in particular. You don't sound that negative.
Look, I look at the system out there. I think there are big geopolitical risks. Sovereign debt risks. I think inflation is not beaten yet. I think so. Yeah, I'm concerned about that. We've not had a cycle in a long time. I just look at it more like the probabilities. I think the probabilities of something going south are more than other people think. I would price more into the market if I could. Like I said, we don't run our business that way. We run our business so we can serve our client. But I think there's a little bit too much exuberance out there that everything's going to end up fine. I just think the odds of that not ending up fine are higher than some of these other people.
Do you think the bigger risk is inflation or an economic downturn?
Well, I think they're related. I think inflation can cause the economic downturn, but the economic downturn just could be just, when you look at history, I have been through so many past, I've studied, I even asked AI, what happened in 73, what happened in 82, what happened it's a confluence of events that are hard for you and I to see in real time. And it's not one thing. It's usually a multitude of things.
Jamie Dimon, the chairman and CEO of JPMorgan, thank you so much for being with us. Back to you, Carol.
All right, so appreciate it. Great stuff. Lisa Abramowicz there in Miami, there, of course, with the CEO of JPMorgan Chase, Jamie Dimon, there at the JPMorgan Global Leveraged Finance Conference in Miami. Let's get a quick check on the market trade, if we may. We see equities actually pulling up to their best levels of the session. What does that mean? S&P just up about 1/4 percentage point. You've got the NASDAQ 100, a gain of about 1/3%. You flip it on over to what we are seeing in terms of Treasuries, and that's where we've seen an interesting trade. As we've talked about this, some of the inflationary concerns because of the rise in energy prices, also some economic news that we got out of the manufacturing sector here in the U.S. So right now we're looking at a 10-year with the yield once again above 4.04, and you've got a 2-year note looking at the shorter end of the yield curve curve. Let's try that again at 348. And then flipping on over to some of the energy. I'm looking at nat gas, Tim, up about 3.7%, and WTI crude up about 6%. Gold also moving higher.
Yeah, and if you look inside the S&P 500, given what Carol just said and everything happening around the world, not surprised to find that energy is the best performer in the S&P 500 right now. Information technology up 1%. Industrials, that's where you find those defense stocks, those defense names, that is up 1%. Laggards include consumer discretionary, consumer staples, and healthcare. We should note, Jamie Dimon, that interview with Lisa Abramowicz covering a lot of ground. Some headlines include that right now the U.S. economy is doing fine, but at the same time, and this came, before he made some comments about AI, he said, there's more exuberance than there should be.
He did. He did also note when it comes to private credit, he said not in the systemic area, yet that we are late in the credit cycle in general. So that reminds us of some recent reporting by our own Bloomberg team. It was about money manager Danny Moses, the Danny Moses immortalized in The Big Short, who made some comments, probably lives with you forever.
He's here.
He's here. He made some comments last week during panel at the iConnections Global Alts Conference. It was in Miami Beach, Florida. What he said was that private credit and private equity firms push into retail products reminds him of the years preceding the subprime mortgage crisis. So we are kind of hearing a chorus akin to reminding us all about the GFC and what happened then. Danny Moses is founder of Moses Ventures. He joins us right now here in studio, along with Bloomberg News equities reporter Alexandra Semenova. Danny, also host of the weekly podcast On the Tape, and co-authors the Substack, What Are We Doing? Contrarians at the Gate, with his fellow Big Short partners. So delighted to have you here with us. How are you?
Great to be here. Who knew what I would say one thing in Miami, then I'm sitting here 4 days later. So it's always great to follow the king, Jamie Dimon. So great. Let's go. So.
Well, anything the king said that you thought was kind of interesting, because he did talk about private credit, which is something that's definitely on your radar.
He sounded much more positive than I thought he would.
Yeah.
He's optimistic. He's down at a leveraged finance conference, so I think he probably needs to be. I think he focused on the right things. You can't predict when we're going to have a downturn, but what might cause it. I'm in the camp that actually the stock market has added such a wealth effect to the economy that it actually could be the stock market selling off that actually slows the economy. So they're all kind of intermixed here. And the stuff we can talk about, what I said down there about private credit, how I think it rhymes with previous cycles, but every cycle is different.
So let's go there and talk a little bit about how it rhymes with previous cycles. Where does it rhyme specifically, and what concerns you?
So the whole thing about this cycle is that it's not systemic. We don't have the risk. The banks aren't there, so we don't have to worry about depositors being at risk. The similarities are that the banks are lending to the private equity and private capital firms, right? That's going on. They did the same thing to the mortgage companies in 2004, 5, and 6, leading up to the crisis. What did they do? They provided warehouse lines to New Century or Credit Home Lenders countrywide. So they went out, produced the mortgages. What did Wall Street do? They bought those mortgages, packaged them, and sent them out to CDOs, and everyone bought them.
Great old cycle, right?
Same cycle. The same institutions that are now buying, all this credit. And so as soon as Wall Street sees credit turn a little bit, what they'll do is the credit lines that they're now providing into that sector, they'll tweak it a little bit. They'll pull some back. Then what happens, you get left. The reason these mortgage companies went out of business was because they couldn't sell it anymore and it got stuck on their balance sheet. Chair got pulled. So then the real marks start happening when liquidity starts to dry up, and it exposes the leverage. So whenever liquidity dries up in any asset class, it exposes leverage, and no good asset goes unlevered is basically how it goes. So.
It's been incredible, Danny, to see that stocks haven't been toppled by anything that has happened this year. We have so much geopolitical risk. We have AI concerns, private credit. What is going to be the headwind that actually sends us into a correction or worse?
I think it's unemployment. So earnings have been strong enough, I think, to carry the market. I think we've had a broadening out within the market, which has been healthy into other sectors other than tech, which is great. But I think you're starting to see trends potentially in employment. Now, this memo that came out last week that I'm sure you guys were talking about all week, this Trini memo about what AI could look like in 2028, the apocalypse, so to speak, there's some truth to it. And you have to imagine what can happen. So you get all the benefits of being efficient as a company, and your margins improve, so you get that now. But we saw already from Block and what was said, firing 40% of their staff. OneNote literally took pages, it felt like, out of the memo and said, this is what we think we can do now, be more efficient. So, and those are white collar jobs, and so that's in the economy.
Well, to be fair, I think we're all trying to figure out, is that a Jack Dorsey figuring out the future of that company, right, in terms of management, and whether or not that is an indicator of what's to come.
And there are a lot of people who say that's not something that it's
right.
Reduction in force that's sort of camouflaged as an AI. Like, this is bloating. We're going to be speaking about this a little later.
He certainly overhired probably post-pandemic, but what he said was irrefutable in terms of why he believes there'll be more efficiency, and that that he doesn't need humans to do all the jobs that they were doing before.
I want to go back, though, to over leverage, because I always think about who's exposed ultimately. Like, what happens when the tide rolls out? And I'm just curious how you see potentially a crisis akin to the GFC happening because of private credit.
So I think in terms of it fueling the economy and economic growth, companies being able to access credit is great for employment, right? It's great for companies to, but maybe they otherwise wouldn't have gotten it, or maybe the leverage is too high, or maybe the covenants are too light that allow these companies to keep borrowing, modifying loans. As soon as the money stopped coming in, or slowed down, I should say, on the institutional side, what did we see? We saw private credit get offered on the retail channels. Well, some of these banks and brokers are incented to get it onto those channels, and that's my point. When retail investors get the opportunity all of a sudden to buy something,
right?
Caveat emptor.
Listen, we talk about this a lot.
Yeah, this is what we just talked about with Mike Contopoulos. I mean, the idea that it's a signal of something, that the market becomes more available, or what he said is it becomes more democratized. So in your view, not a good idea for the everyday investor to have access to these products?
If I were a retail investor right now looking to get myself exposure, I would be buying Blackstone, KKR, and Apollo. I'd be buying the parent companies, the large PE firms that have permanent capital, that have a huge fee income stream. That's how I would expose myself. And guess what? I can buy it and sell it in the same day.
You wouldn't be putting private credit.
I wouldn't be
private credit. Funds in your 401k.
If I had a retail broker that called me and offered me that, I don't think he'd be my retail broker anymore.
Buying those names are liquid, as you know, like Recover, right? These firms you can sell and buy easily. But come on in, Alex, because I know you're listening.
Yeah, we're talking about retail investors, and I actually wanted to ask you, Danny, one new segment of finance that they're actually foraying into is prediction markets, with kind of the excess cash that they have to spend. What do you think that will look like later this year as prediction markets continue to grow?
Well, they're regulated by the CFTC. They've taken an extreme amount of market share from the traditional online sports books that we've seen. But it's really interesting because I actually use them as a way to follow the news. Not that you guys don't provide all the news that I need here, but you want to know what's going on in the election in Brazil, and you know that you want to either buy or sell Brazilian equities as a result. Watch what's happening there. So you don't have to trade those markets, but you need to watch it. And it's really interesting. One pops up, you're like, I never even thought of that.
I've seen Goldman Sachs, JPMorgan, a lot of big institutional firms citing prediction markets in their research notes really often now.
Right, and they're partnering in the media. They want to get it out there more. I get it. And listen, it's growing. It's a sector that's evolving. But sorry.
Please. Finish.
No, it's all about
we talked
regulation.
About during the elections, right? Like, go ahead.
Exactly. It's where the regulator lies. It's not at the state level. It's at the federal level.
So that use case, I think, to a lot of people makes a lot of sense. But the question, and this is a real question that is available on some prediction markets, will Jesus return in 2026? Right. Yes or no? Doesn't necessarily carry the same weight, I think, with someone like you. That's a sign of something.
Yeah, well, I think there's an entertainment value. But I want to say, let me give an example of something that I just talked about on my show the other day, which is, will the U.S. debt exceed $50 trillion by the end of 2028? Even the CBO, which is nonpartisan, has literally 44 trillion. I'm negative on U.S. debt. That's a whole nother topic we can go into some other time. But if it hits 50 trillion, to your point, I say you trade no on that. Because if it's yes, we have a lot bigger issues. What, did we have another pandemic, another financial crisis? We bailed out private credit in the tune of 3 to 4 trillion. How did we get to 50 trillion? So when I see stuff like that, and it's trading at 50 cents, so it's trading at a 50% chance right now, I watch stuff like that to tell me, and if it starts to move, then I start to dig deeper. What am I missing?
You watch it, but you don't participate in it.
Oh, I participate in it.
Okay, how do you participate?
I trade on Kalshi. I trade these markets. Will the S&P close below 7,800? I trade yes. It will trade below 70 at the end of the year. Will gold outperform Bitcoin?
Right.
Yes, I believe it will. And it's interesting to see how they trade. Will the Fed cut? CME Fed Fund futures will match up directly what you will see on Kalshi in terms of, but I don't want to set up an account and trade Fed Fund futures, but I can just trade yes or no, the 4% chance that they're going to cut in March, maybe. So it's
how much do you allocate to a platform like that?
Not a ton, but enough that it's entertaining.
Yeah.
So I do my NFL there now, during football season.
So there's a lot
I'm going to do my Masters there during the golf tournament. So you use it all, but yeah.
I want to ask you said bail out of private credit. Do you think we get to that point?
Well, I would.
You said it.
Yes. No, if we got to that point. So let me ask you a question.
If we got to it.
If we got to that point. Jamie Dimon just mentioned that things are okay. My issue is that things are okay because the Fed keeps bailing us out. There's a moral hazard, and I believe it's in the back of people's minds that actually believe, if private credit goes, the Fed's going to have no choice but to bail it out, and they're probably right. It will have an impact on everything, impact on the banking system.
Right.
It won't bring it down. So I'm half kidding, but I'm not. So what did the TALF go, again, a whole nother segment, but post-financial crisis, the TARP, the TALF, the PPIP, we ran out of acronyms, right? So we're going to come up with another one. It could be a vehicle the government subsidizes a period of time. What did they do during COVID? They bought the HYG. But people forget, pre-COVID, we were already going through an economic downturn, and it's kind of resurrected companies that otherwise shouldn't have been saved.
So if President Trump brings in a new Fed chair who is more comfortable with cutting rates, does this just fuel the problem or make it even bigger?
You hope Warsh will maintain some form of independence.
Do you think he will?
I hope he does.
Okay.
I don't know.
Because if he doesn't...
Yes, well, then you're starting to see what will creep in. Yields will start to move higher on the longer end, anticipating that whatever they do to move short-term rates will fuel long-term rates potentially higher, and you start to ignore inflation. You cannot ignore right now that inflation has stopped going down.
Yeah.
And it's ticking back up. Is it just for a period of time? We don't know yet. But with oil now moving higher, it seems so it's something really to think about, the Fed's ability to cut rates from here. So.
Danny, Lisa asked Jamie Dimon this question. I thought it was a great one. Are you worried more about inflation or about an economic downturn?
He kind of said both go to that. I'm not that concerned about inflation. I'm worried about the question you just asked. If the Fed starts cutting in the face of inflation, what that would look like. I think the economy's fine, but I think that we got to watch employment really carefully, and I think that's what everyone's spooked by this AI memo that kind of came out. We're already seeing signs of that, of white-collar jobs getting lost. So.
Yeah.
We're speaking with Danny Moses, the founder of Moses Ventures, financial computer, and a host of a new weekly series, The Danny Moses Show on Scripps News. He joins us here in the Bloomberg Businessweek studio. Let's go back to what you were saying about AI and the economic effects of that and what that is on the labor market, and dig into the Citrini report a little bit, because you did mention there are parts of it that rang true and other parts not necessarily. And we'll use the Jack Dorsey block news as sort of a jumping off point. Those are white collar jobs. The message was received and has been received. Is that something you see other companies doing over the next 18 months? Reduction in force of 40% and more.
The same way no one was allowed to say tariffs a year ago on their calls, like don't blame tariffs. So they're not going to say it. But why wouldn't you as a company? You're a publicly traded company. You have shareholders. Your job is for margin expansion and to produce earnings. If you see the opportunity to do it, it's not a non-for-profit. You're going to do it. And so there's no question that these tools, if you believe the AI secular trade is real, which obviously it is, it's going to have an impact, and you're pro NVIDIA and you're pro all this stuff, then you have to believe there's an end user case for it, both in the consumer and company-wise. And so if that's the case, by definition, you'll be more efficient. I think my takeaway would be, the U.S. consumer finds a way to make jobs around it. It could be something that helps guide that technology. So there's always going to be movement in that, and we've seen massive changes occur. The .com in 2000, right? We heard there'd be no more Wall Street jobs in 2008. After that, it's over.
Right.
Finds a way to reinvent itself. So I just think it's a think piece to think about. Okay, but there's not a CEO, a competent one, that's not already thinking, how do I be more? That's even. Jamie said it, that they use it. Now, he didn't want to say they're firing people, but...
I mean, everybody's using it, and everyone is telling us that if you're not using it, you're falling behind. And we are planning a Bloomberg, not me, but our team, a Bloomberg Invest event that comes tomorrow, and there's a big AI thing that you and I are both involved in. And it's interesting, I've had some conversations about, people say what you should do right now is talk to a 25-year-old. They get how you can use these tools. And the idea is that there will be a dislocation, whether it's 5 years or 7 years or maybe a little bit longer, between maybe an older workforce who's not going to embrace these tools and then a younger workforce who will. And that will free them up from some kind of tedious tasks, but create new opportunities. Right. Do you not buy that argument at all, that that's ultimately where we end? And it's going to be uncomfortable, perhaps, because education's maybe going to have to shift around a little bit and teach things that people maybe lose, or would learn on entry jobs that they're not going to. So there's a shift. So
you have lawyers, you have accountants, and now you're going to have AI tutors. So there you go. There's a whole new industry that could happen. No, but in all seriousness, there are huge positives to it in terms of making every company more efficient, making U.S. consumers more efficient. So that comes with more productivity for everybody. So maybe there's an offset there. I think, again, back to this memo, we don't spend a lot of time on it. People that are saying yes, yay, or nay on it, you got to read it. Because again, it's a long read. I mean, it's a 30-minute.
What is everybody missing?
Just that it's a think piece to get, and it's logic. You can't refute that could happen, and it will happen in pieces. And like I said, yes, Dorsey example maybe is just a one-off or whatever it might be. But I do think you talk to any CEO, they're not going to tell you that necessarily. But you know, so somebody's spending CapEx for a reason. Somebody's plowing money into these privates for a reason. Somebody believes you wouldn't be doing that unless you thought there was an economic benefit. Well, it's a zero-sum game to a degree. So you don't just increase productivity and everybody wins. I think there's winners and losers here. So.
It was amazing, Danny. Just a couple of weeks ago, we saw entire sectors being sold off in tandem, just being dumped because some AI startup said that it was going to replace jobs. Have you ever seen anything like that in past crises? And if that happens again, how do traders navigate that?
Well, I mean, so that's software companies, SaaS companies that always thought that was the best model ever. Yeah, I saw it. Your bank's going to close down, so go get your money out and line up around the block, right? So what did that take? It was the FDIC to come in and say, no, we're okay, TARP, the banks are going to be fine. So yes, you see that panic happen. You saw stocks, you saw Bear Stearns go, you saw Lehman go. Things actually did happen. That even shocked us to a degree. So yes, you will always have whatever the kind of sector trade of the time is, and you will always get an overreaction and creates opportunity potential to buy.
Well, did you trade on any of that?
Which, on the software stuff?
Yeah.
Nah, I'm too negative. No, I'm kidding. No, I didn't. But there are names. There's always one-offs, and I think I will end with this. We're focused on AI and all these sectors. There's so much going on outside of just the technology trades you guys talk about. And all of a sudden, everybody's energy playbook's out in the last week or so. Like, oh, wow, these stocks are cheap if oil were to even stay at 65. These stocks are, and it's 3% of the S&P, 4% of the S&P.
Right.
Could be 7. So I just think there's always opportunity to move around. And there's certain sectors which will not get AI'd away. And so as a Wall Street participant, I think you need to focus on
We want to go back to risks, but what do you think, what do you find most interesting in the marketplace today?
Gold and things that no one was. Now everyone's on gold, but things.
And you're still on gold?
Yeah, still long gold. Long the gold miners. I think it's up trade. Yeah.
When do you stop that trade? Yeah.
Listen, it's a $35 trillion asset now. No one talks about the size of it, but it's really big. But geopolitics just reared its head again. Debasement, inflation. It works in a lot of different ways, and it's really a play that central banks are incompetent to a degree, and they're going to do whatever they need to do. So if you think the way out of this, potentially, I just mentioned, is the end game of this bailing out private credit at some point? I don't know, but gold kind of prices all that in. But to your point, these stocks move. The gold miners are up, 100%, whatever they are. Of course, you have to take some off the table. So.
What about spot gold at 5,300?
I like it, but I play it through PHYS, which is a physical.
Okay.
So, but yes, there's ways to express it. But just I kind of watch the flows, watch what's going on, and you got to be smart with it. So I'm not giving advice here, but
retail also big participants in metals markets right now.
Yeah, metals, silver specifically. I think every metals market's a little bit different. I think the commodity trade is here to stay. I really do.
Yeah.
And so
we're all pulling out our old jewelry. And
exactly right.
I'm not joking.
You can't even get on 47th Street. There's a line out the door. So
I'm not joking. Having said that, back to risks. Whether it's private credit, whether it's geopolitics, what do you see as, especially as we continue to see a president who seems to kind of do what he wants around the globe in terms of either taking out leaders, for lack of a better word. So how do you factor in geopolitics? Because I'm kind of shocked at the trade today. I expected something much worse, and it was much worse overseas, but maybe that makes sense.
Alex and I were just talking about that before we came in, and I think a lot of this was priced in. So what did we see at the end of last week? Oil started to move higher, but not to the mid-70s, but West Texas moved up to, call it 68. Then you had Treasury yields lower, and it was kind of odd. Treasury yields were moving lower in the face of higher inflation prints. You're like, well, is the economy slowing? What's happening? And gold was moving higher, and metals were. So you kind of got some. So today is more of a buy on the news type of event. So what happened today? The microcosm I'm looking at today is the U.S. dollar rebounded.
Yeah.
The belief that the U.S. is still the ultimate power, the belief that we haven't, hurt all our relationships, so we can be a trusted partner. We got a little glimpse of what that could be, because war always rallies the dollar. I think it's short-lived. So to the point you're making, I think this is a kind of a false bounce. We forgot all of a sudden about the AI trade. You have this MFS in the UK blowing up, which would have been front page news on Friday and today if there's other stuff. So that's page 2 right now. But here's another, mortgage lending type, again, not systemic, but also just a sign that money has been circling around the globe trying to find a place to go, and sometimes it's too easy, it's too free. So I just think in general, and the last thing I'll say is I am very concerned about U.S. debt and debt to GDP. That's my big, I know it doesn't matter, no one cares.
But it should.
It matters, because one misstep here.
Well, when does it matter? When does it matter?
Well, again, I'm not going to call a failed auction in the 10-year yield, but when you start to issue more T-bills instead of 10-year notes, right? When you start to do those things, you by definition create refinancing and repricing risk down the road. So if inflation does come up and the Fed's hands are tied, all of a sudden these T-bills, which you're issuing instead of 10-year, because you don't want to put pressure on 10-year bonds, just doesn't work. And so all we did from 2008 on was just move the risk to the government balance sheet. But you're not going to outgrow it. You cannot. We are not going to run a surplus in this country. We're going to run a deficit. Is it 1 trillion, 2 trillion, or 3 trillion a year? I don't know. Back to the cow sheet, 50 trillion at the end of 2028. We're under 39 trillion right now. That's almost 12 trillion from here. So that's a big concern, because if our rates start to move higher, there's so much to worry about. Just buy U.S. I guess just buy stocks. Honestly, I don't even know. So
I got cash under.
Yeah, I got cash, exactly.
Because you brought us all together. Got 30 seconds. You want to do the last question? We've got a minute left.
I guess, Danny, Wall Street retail investors have this penchant to buy the dip over and over again. And at what point does that backfire on them? Because it's worked so far over the last few years.
Just got about 30 seconds.
I think it's self-fulfilling. I think that even through the tariff crisis of last year, ongoing tariff crisis of last year, ETF flows remain positive. Mm-hmm. So passive has still been positive, but that comes down to one thing: employment. If people start to lose their jobs, they're not putting in monthly into 401k. So that would be where I see the risk.
Right, you lose the momentum. Danny, thank you so much.
Thanks
come
for
back
having
soon.
me.
Alex, the two of you, come back soon.
You got it.
Danny Moses, founder of Moses Ventures, financial contributor and host of a new weekly series, The Danny Moses Show, and of course our Alex Semenova. She is Bloomberg News equities reporter. All right, do not go anywhere. We're going to check in on the trade and also your stocks on the move. This is Bloomberg Businessweek Daily.